Hey, welcome to the closing beat, the recorded version. We're doing this different. I wanted today to go well because it obviously is a very important day in the stock market. So we're recording this one to post for you guys instead of doing it live. Something's going on with YouTube because we know all of our stuff is good on our end. So let's cover the markets here. I'll skip all the normal stuff. I did want to point out Dave Brubeck, the song Dave Brubeck, Down to Earth is our jazz artist of the week. And it just kind of fits what was going on. So I thought that was a fun song. Anyways, we're going to go into the markets here. We'll make this quick, get right to the point. Rough day. Right? Really rough day. Stock market sharply lower. We actually gapped down 2% on the day. Really, really weak. If you look at the stock market there on the right-hand side of your screen, the NASDAQ was the NASDAQ was the best out of the group, but the Russell 2000 was the weakest out of the group. In the NASDAQ, which was down 5% year to date, which is down 6% year to date. It was down, or it was up 12% year to date yesterday, and today it's only up 6% year to date. That's pretty crazy. If you look at the Russell 2000, down 18% year to date now. That was also 12, but negative 12 yesterday. So let's go through that real quick. I'll take a look and show you. If we go into the NASDAQ here, you got a couple things that held its own today. If you look at Zoom, for example, it's going to take a second to pop up, but you got Zoom in the mix. That kind of held its own today. Not too bad, up 0.5% on the day, really strong. Stay-at-home stocks, that was the focus. Your stay-at-home stocks did well. These will be your gamers. Take-Two Interactive, which held up. I'm not saying they were positive today. They just held up relative to the broad market. Citrix in the NASDAQ as well, only down 2.4%. You got Fox, right, sitting at home watching your Fox there. Well, actually, Fox finished down 7%. That one doesn't count. Cross that one off the list. And then you got EA Sports only down about 2%. So in the NASDAQ, some of those tech names, software tech names that are more stay-at-home related, they got the attention because everybody's like, hey, virus is coming back. And so that was part of that one there. In the Russell 2000, if you're looking at that one, it was your virus-sensitive type stocks that were the weak ones there. So for example, we'll look at Churchill Downs. You guys know what they do, right? Racing the horses and dogs and stuff. Churchill Downs down 11% on the day, back to the 200-day moving average. El Dorado Resorts, in fact, anything related to gaming was weak on the day. Here's El Dorado on the screen. Penn National, also weak on the day. Gaming, gambling, things like that. You can imagine with the virus second wave kind of being reported out there. Here's Marriott Vacations, also down on the day. And so in the Russell 2000, those are some of the names that were quite weak. All right. Not to be that guy, right? I don't like to do this, but if I tell you ahead of time, then I get to kind of, give a little credit there. It's not really my style, but I hope over the last week or two, you had the opportunity to slow down your portfolio. I hope your advisor, if you're working with an advisor, made it clear that this is time to start slowing down your portfolio. We are not active managers by any sense of the definition, but we did start telling our customers a little over 2 weeks ago, we're going to start slowing down the portfolios. This market is getting extended to a point where it doesn't make sense. I highlighted as many different things as I could in a class for customers, and I've been trying all week to get your attention here to say, hey, here's some things that are really odd, right? They just stand out as the market's extended. Don't get too excited. I know you guys got it. I saw some of the emails. I saw a lot of the comments there. We started off the week talking about analysts being wrong by such a large margin of error. Go back and watch the show earlier in the week. It's not that they were wrong. It's that we were wrong, right? Or the investors were wrong there. Analysts, they don't get this wrong. And so I highlighted the spread between where prices were and where analysts were and how big that was. Never been that big before in the past. We then went on to the declines versus the gains. Maybe we'll go back to the full screen there. I'm not using the chart at the moment, but we have the declines versus the gains, where we were talking about this, how far we fell since the virus kicked in February 19th. Then we talked about how far we've been rallying there and how that was really a dissection in the overall performance of the market. That's not supposed to happen. It doesn't happen. And so I tried to give you all of those stats. Then we talked about valuation yesterday a little bit. I'm going to expand on that today because that was important. That was another way to kind of give you guys a hint that we're just extended. You can't get too aggressive here. Really pretty tough. Other things that came out today, weekly jobless claims. Anyways, the point I was trying to make there was I hope you slow down portfolios, long-term investments. It's an opportunity to do that without being active. I get that argument, but slowing down. We slowed down 20% here at Jazz. did a special class for clients to tell them exactly how we were going about it and to kind of give them a heads up. And the argument there was I'd rather miss out on the last 5% because that 5% may only be a temporary 5% than to suffer through something sharp as like that we saw today. So just looking out for you, right? Give me an idea. What'd you do? Did you slow down? Did your advisor call you? Whoever you work with, let me know what's going on there. And if they didn't work with you, of course, sales pitch. So I'll throw that out there. Weekly jobless claims fell for the 10th straight week. That's actually never happened before, but it gets a bit of an asterisk because, well, unique situation, right? So it gets a bit of an asterisk because we shot up so far. We've never shot up so far in history, but we've also fallen for the 10th straight week there. It was also the largest week over week decline, so it was a little bit of good news. The problem is, as I told you guys 2 weeks ago, continuing claims. That becomes the focus going forward. I even put in our notes from Jazz email to say the initial jobless claims are one thing, but going forward, people are now going to start looking at continuing claims. How many people continue to apply for jobless claims? That number is 21 million, unfortunately. So there's 44 million jobless out there, 21 million that continue to apply for it. In other words, they didn't go back to work when it all seems like everybody's going back to work. So that's something there. Because of that, you got the markets moving. Well, that's one of the reasons, but you got the markets moving lower. Let's go over the charts, take a look here. We'll see. We'll start with the S&P 500 just to take a look here. You've got a 5.4% decline on the S&P 500 back to the 200-day moving average. It looks scary, and I'll agree that it was a nasty day. However, you know, we've had 3 other 5% pullbacks already. It's just you didn't really notice because it didn't happen in one day. So how do you feel about today's market performance? You're likely a little on edge, a little bit nervous and stuff, and you probably should be. But we've actually had 3 different 5% pullbacks here, if we can actually show it there. I don't have a line that'll be like clear enough to draw, but you can see it in here. 5% over a few days, 5% over a few days, 5% over a few days. This was just 5% all in one day. So it feels tough because it was one day there. I actually just commented to a customer, Aaron K out there in the Carolinas. He was talking about this market moving higher and should we just start like adding in and doing some stuff there. And I said, here's the problem. We're so extended. I gave him all the stats I share with you guys. I said, we're so extended that when we do fall, we don't fall calmly. In fact, we'll fall sharply. I just talked with him last night. So Aaron, right? That's what I was talking about. So we're back to the 200-day moving average there. 3/4 of the S&P today fell 5% or more. That's 75% of all the stocks. 365 of them fell 5% or more today. So there really was nowhere to hide. That's kind of the moral of the story. It's also a trend day, by the way, or a program day. I don't know how you want to talk about it. But look at how this fell today. There was no panic. This is pure profit taking. This is little profit taking over and over and over and over again because there's no waterfall drop. Here's a 5-minute chart looking back to 9 o'clock this morning, really overnight as well, using the futures here. It was a steady profit taking move little by little throughout the day. That's not panic. So that's a different type of decline than when you see people freaking out about whatever it may be in the news or responding to some sort of headline. A little bit different story. Now, I told you we're going to expand on the valuations here a little bit. Here's where we started. I talked about this earlier yesterday. We showed this, that if we look over the last 10 years, the valuations of each individual sector, as well as the S&P 500 in the blue, is at the top of its 10-year range, meaning we are almost as expensive as we've ever been at a market that had yet to go back to highs, right? So a lot of expensive areas, technology, consumer discretionary, etc. Then we went and we said, okay, let's put that in the background and let's talk about all the sectors, how they looked when the market was at new highs there, or was at February 19th highs, right? Back at those levels. So we talked about that and we said, okay, well, look, some of these areas are just as expensive as they were before. What happened? The markets took a break. Now, naturally, it was virus related, but the bottom line is the markets took a break. So it's trying to highlight another way to show you guys the markets were expensive. Today, I want to expand on this by showing you the forward performance of the last time it happened, because if you look back on this guy, where is it? This guy here. There are only 3 other times in the last 30 years, and in fact, there's only 1 other time in the recent history that I can show you. This is very rare that this actually happens. So what we did is we plotted the last time that we can find this happen, which was in March of 2000, in red on the screen there, and then we plotted actually what's happening now. This was as of yesterday, so there's naturally going to be more of a decline there. The blue line is where we're trading at right now. So if you look back, We don't have a lot of data to go on, so it's not the greatest study. But look, 1 month later, markets were lower when valuations were as stretched as they were. 3 months later, the markets were still lower when valuations were as stretched as they were. 6 months later, the markets were still lower. And 1 year later, when valuations get as stretched as they were, we still pull back. So I can't actually tell you guys, I think the market's going to pull back. I think you should do something, but I can offer research and data to hopefully drive you to your own conclusion without breaking any rules there with the SEC. Hey, by the way, our FinTips videos this week, kind of interesting. The first day we did how to build a dividend portfolio with volatility in mind. A lot of people talk about buying dividend stocks and oh my God, so exciting. I took it an extra step and said volatility. So what happens if you account for that volatility in there? Should you go this way or should you go this way and get the same dividend yield but with less volatility? That's going to be really important right now, as you might imagine, with the markets doing what they're doing. Yesterday we did how to invest if you're 42 years old, specifically how much and where to put those dollars. So I hope you'll check that out. And tomorrow we're going to do thematic ETFs. Really kind of an interesting one there. Tonight, if you're one of our customers, our Wine and Wealth class, we're actually going to talk about the market's performance and show every single market's performance at the moment that it was labeled that we were in an economic recession. So you can see, do the markets actually get worse? Do they get better? How far through the recession were we when it was marked as a recession? I love sharing that stuff with you guys. That'll be tonight at 8 o'clock, of course, there. All right, let's go over to the sector breakdown here, see what we can do. There was nowhere to hide today. Every sector was lower by 3% or more, and 8 sectors were down 5% or more. Let's talk about energy. That was your worst performing area of the day, falling almost 10% on the day. Continues with that sharp pullback, now erasing everything that it happened to have there. ExxonMobil and Chevron were 2 of your biggest decliners on the way down with 8% and 8% declines respectively. Chevron back to the 50-day moving average there, a complete reversal of everything that it had accomplished in the last couple days. One Oak was your biggest decliner. So ExxonMobil and Chevron were the biggest contributors to what happened. One Oak was your biggest decliner overall. I do want to point out Occidental Petroleum, nasty pullback there as well, and Halliburton nearly taken first place with the biggest loss of the day if you're in that category. Oil on the day down 8%. Big pullback in oil, and well, I mean, there's not much else to say there. It's had a good run, also seeing some profit taking as well. Financials, oh, no, we're going this way, XLF. XLF down 8% on the day. Very strong pullback overall for financials. Finally gets on the same page as tech, which is kind of funny. It's just in the wrong direction for most of us. Financials down 13% since hitting this 200-day moving average there. We talked about that earlier in the week and last week, how you got to respect that area no matter what you're looking at. Wynn Resorts is an example, the oil stocks, financials as well. You got to look at that. Great lesson for us there. Or for everybody. JP Morgan pulling back. There was one of the bigger contributors to the decline today. Bank of America down 10%. You also had the yield curve flattening just a little bit. That didn't help. You got consumer staples down 4% on the day. This one at one point had held up the best, and it actually held up the best out of all of them throughout the day. It was kind of thanks to your virus supported areas. Remember, Kroger did well during that initial virus decline. It recovered quicker. Today it held up. Most people thought, okay, if there's the new second wave of virus, then maybe this will hold up again. It pretty much killed it during the first wave there. But you're also going to notice names like Clorox. It outperformed the market today, only down 1% on the day. And Walmart, not even down 1%, holding above the 200-day moving average. They all outperformed the sector. Biggest drags on the day are going to be Coca-Cola, 6% breaking through the 50-day moving average. Pepsi, pretty much the same story, down 5% on the day. And what was the other one? Procter & Gamble. Yeah, down 2% on the day. Not too bad, actually, the way it finished. Moving over to industrials. You got a 7% decline in industrials. That's back to negative. Over the last 3 months, industrials are now negative overall. Boeing was your biggest drag overall, 16% to the downside there. They were the biggest drag on the industrials by more than double any other stock in that category. Delta Airlines, you can imagine. Airlines, come on, they're a little bit weak there as well. Delta down on the day by 14%. Alaska Airlines, one to notice at 14%. Southwest Airlines down 11%. You get the drift there. Move over to healthcare. You got healthcare now, really no chance of a breakout, right? So we were talking about this yesterday, how you don't see healthcare taking off because nobody wants to assume it's going to break out. Everybody probably felt pretty good about it, but you don't want to assume it in this market with everything being so extended. And so because of that, you didn't see these monster gains there. You have everybody just sitting there waiting. Well, those that have been participating took the opportunity today to take their profits, realizing this breakout was not going to happen right now, and there was no sense in participating given the limited reward versus the risk you had to take. This is a great example of risk to reward, as we've been highlighting there for you. Before you take a trade, you got to know. All right, consumer, there you go. Communication services erases 8 days worth of gains there. Facebook, by far the biggest drag on consumers, communication services, down 5% on the day. And as you can imagine, you got the downside like Live Nation with the virus concerns. They're not putting on concerts, and now maybe they'll be delayed even further, down 9% overall. I want to point out VIX real quick. Your VIX had popped 50% on the day. That's impressive. Doesn't matter how you want to look at it. The VXX about 35%. Strong day for volatility. If you look over to gold, you got a gold up 19 bucks on the day, although the electronic session, it did give it back there. 1741 is where it landed after hours. It seems to be pulling back just a little bit there. And we talked about oil already. Yikes. All right, let's go to the technical breakdown and talk about this one, because you only have 3 stocks that hit new highs today. That is the lowest number in the last 4 weeks. The fact that we've only had 3 stocks there. They're going to be virus-related names that held their own today and actually popped at one point. Electronic Arts up in the mix there. Domino's Pizza, which did really well through the main virus decline there. And Regeneron Pharmaceuticals was in the news for testing out their new virus, COVID-19 vaccine there. We didn't have any new 52-week lows, although another couple days like this, and I'm sure we will. We're going on 4 weeks, over 4 weeks, so we haven't had a new 52-week low. Let's talk about some of the stocks that technical stocks we've been looking at here. Win off the 200-day moving average. You get it? Right? We hit the 200, walked you through every single day of those things there. I think we could take that off the list. Maybe we'll come back to it if things start picking up on that one. Vertex down 3, almost 4% on the day. This is the one we mentioned yesterday. It was getting going, but it wasn't getting going like the rest of them. It stuck out. And when you have a handful of positions, you can see every day, this one's doing well, this one's doing well. This is a healthcare, biotech stock doing well, but here's old Vertex not doing well. And I mentioned yesterday, when you see that, you got to be willing to raise your stop. If you're a short-term trader, you got to say, I'm going to reduce my risk. I'm going to peel out half my position, raise the stop on the rest of it. Got to be able to focus on that. And that's exactly the case there. I think we can move on from that one. F5 Network, we hinted at maybe a little bit of a breakout there. That's not going to be the case now. It did not break out and probably will not anytime soon, nor will it attract that attention to get above those highs. Autodesk was your counter trend trade we talked about yesterday. Don't you feel like it was getting a little extended? I have to say it that way. Naturally, the pullback today did help. It helps if you time those things with a down day in the market. That was pure luck. I'm not going to try to pretend to be a hero there. And that's really kind of it. I mean, stocks in the news, you might have saw Uber down on the day by 10%, and Lyft was down on the day. California decided that those guys are officially, the drivers for those companies are officially going to be called employees, right? Different, they're not subcontractors anymore. You also had second wave virus areas. I don't have a fancy name for it, but you had like your Jets ETF. Of course, that pulled back with the airlines pulling back. We talked about the airlines. Here's American Airlines down 15%. You also had things like Simon Property Group getting some attention with a big decline today, 14%. Kimco Realty, there you go, down 10% on the day. Naturally, you know, Disney, things like that, down 8%. SeaWorld, always a fun one to look at. That was down 10% as well. Second wave of virus type excitement that you see out there. And so, yeah, that's what you have. Now the question is, where do we go from here? And so we will make that our discussion tomorrow to kind of go through expectations and what happens when markets fall aggressively all in one day versus sort of bounce along the way. And yeah, we'll see what happens. I hope you enjoyed today. We've been sort of waiting for this pullback. And again, I hope whoever you're working with helped you slow down, did slow down, even if they had to pull you along. Some of our customers, I had to pull them along and say, hang in there with me. I'm going to slow things down, despite maybe a little pushback, but this is the type of thing we were trying to avoid. And now it's time to start focusing on how to make the most of that adjustment that we made in our portfolios. All of our portfolios can be seen right on our website there. And I hope you'll consider us if you're getting a little nervous out there, need some help, or want someone to take over that's watching literally every single day. Sales pitch, right? There you go. Got 2 of them in one show today. Anyways, we'll wrap it up there. Get this thing uploaded for you. I do appreciate it. Maybe hit the subscribe button or check us out at Jazz Wealth. And enjoy the rest of your day. See you.